Now, while debt and equity are sort of the two most common and the two sort of diametrically opposite types of capital that we talk about, we also see various types of hybrid capital. And convertible debt is one of those hybrids. Convertible debt is effectively when a company borrows money, so it's debt that in the ordinary course they would repay, but under certain circumstances, that loan or that debt can be converted into equity capital. Sometimes that's at the option of the lender, sometimes it's at the option of the company that's borrowing the money. The specific triggers, the specific circumstances under which the debt could or must be converted into equity will be laid out in the agreement between the lender and the borrower. And typically, investors accept lower interest payments from the company in return for the option to convert the loan into equity in the future. Now, as I've said, sometimes, and so the benefits for the impact enterprise of convertible debt, say, compared to traditional debt, can be lower interest rates. It can be a reduced pressure on cash flows, as typically they can plan, if they plan to convert the debt to equity, they won't necessarily have to pay off the principal of the loan at maturity. And in certain cases, a convertible note can be used to postpone a valuation discussion with an equity investor. And so let me explain that point particularly. So there are two main types of convertible debt. And one, the debt is simply convertible at the investor's option. If things go well and the equity looks like it's going to be worth a lot, the investor converts the loan into equity at a pre-agreed price, at a price that was agreed at the time he made the investment. In that case, he benefits from the increased value of the company. If things don't go so well, he continues to keep the convertible debt as a loan and is repaid back at maturity. That's one type of convertible debt, and that does require that there be a conversion price that's set at the time of the investment. In another type of convertible note, which we sometimes call a bridge note, the conversion is not at the investor's option, but is mandatory once certain things happen. And typically the trigger for the conversion is that the company raises a round of equity investment. And the convertible note then converts at that point into equity based on the value agreed when that second investment happens. Maybe the best way to illustrate this is with an example, and I take this example from one of the deals, a deal with a clean energy access company that we helped to raise financing for in Cambodia. When we did the first investment capital raise, the company was quite young. They struggled to reach agreement with their investors on an appropriate valuation. So instead of potentially reaching an impasse in that discussion, they agreed that the first investment would come in as a convertible note. And when it came in as a loan, that money was used to start the business and to get operations up and running. When the company then needed more money to expand its operations, it was more mature at that point, and it was able to reach agreement on valuation with a new set of investors. Those investors invested additional money into the company as equity. They received a certain number of shares at a certain price per share. And the convertible note investors were then converted into equity at a price per share that was determined by reference to the price paid by the new equity investors. And so that allowed the company to raise the capital it needed, but to really postpone the valuation discussion until it was more mature and its prospects were more readily apparent. Convertible debt that we just spoke about is one form of quasi-equity, really a hybrid between debt and equity. There are other types of quasi-equity as well, and quasi-equity as a term simply refers to instruments that have some of the characteristics of debt and some of the characteristics of equity. One form that we're starting to see more of, and we're structuring into some of our deals, are revenue participation notes. These are a type of investment which is a loan, it's a note, and so it has ultimately to be paid back. But it's more flexible than a traditional loan in that the interest rate is variable, and it varies based on the performance of the company, and in particular, if it's structured truly as a revenue participation note, the coupon or the interest on the loan varies as a percentage of the revenue that the company generates. And so if the company does poorly or doesn't grow as much as projected, it won't need, its cost will be lower. It won't need to pay as much in interest. But if the company does well and the investment has enabled the company to grow dramatically, then the interest rate is higher and the investor is rewarded for that. But presumably the company can also afford to pay the higher amount at that time because it is doing well. So these revenue participation notes have many uses. One reason they're used is sometimes they're used by nonprofit impact enterprises to provide an investor with an equity-like return, the ability to participate in the upside of the business, even though a nonprofit cannot really sell proper equity. They can also be used sometimes to bridge a valuation gap rather than arguing over what valuation is appropriate and what expected performance it can be agreed upon between the investor and the company. Sometimes it's easier to agree, well, if this happens, I'll get this reward, and if a lower result happens, I'll get a lower payment. So, it's a good way of really allowing, on the one hand, the investor to participate in upside, but also protecting the company from having to pay too high an interest rate if performance is less than expected. So sometimes, very often, we and I say this all the time to impact enterprises, that debt is always cheaper than equity. And what do we mean by that? And in fact, very often impact enterprises will say, but you've just told me that with debt I have to pay back interest, I have to pay interest, and I have to pay the principal back, whereas with equity, I don't need to pay anything back, which is true. But equity ultimately, while there's no fixed repayment schedule and there's no need at any particular point in time to pay the money back to the investor, it does carry a cost. And that cost is that by selling equity, you've given up an ownership stake in your company. You've given up a share of eventual profits in the company. You've given up a share of, if the company has ever sold, a share of the proceeds to the investor. And because equity investors take more risk than lenders, they naturally demand a higher expected rate of return from their investment. And so it's really that, when we say debt is cheaper than equity, that the interest rate on debt will always be lower than the expected return on an equity investment.